Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fair Isaac Corporation quarterly report. Fair Isaac Corporation offers a wide range of businesses and services that cater to various needs of clients across different industries. The company's Scores segment provides business-to-business scoring solutions and services, as well as business-to-consumer scoring solutions through its myfico.com subscription offerings. The Software segment is another key area of focus for the company, offering pre-configured analytic and decision management solutions designed for specific business needs or processes such as account origination, customer management, customer engagement, fraud detection, and marketing. This segment also provides associated professional services to support the implementation and use of these solutions. In addition to these offerings, Fair Isaac Corporation provides a range of standalone software products that can be configured by customers to address various business use cases. These include FICO Platform, which is a modular software offering designed to support advanced analytic and decision use cases, as well as other standalone analytic and decisioning software. The company also offers pre-configured solutions for specific industries or business needs, such as FICO Fraud Solutions, FICO Originations, FICO Customer Communication Service, FICO Strategy Director, and FICO Triad Customer Manager. Furthermore, Fair Isaac Corporation provides professional services software, including FICO Implementation Services and FICO Analytic Services. Overall, the company's diverse range of businesses and services enables it to cater to a wide range of clients across various industries, from financial institutions to retailers and beyond. Fair Isaac Corp's stock price has dropped significantly in the past year due to several key events and ongoing valuation concerns. The most substantial decline occurred in July 2025, when shares plummeted by 21.4%. This drop was primarily attributed to two main factors: the Federal Housing Finance Agency's FHFA announcement that lenders for government-sponsored entity mortgages could use VantageScore 4 as an alternative to FICO scores, introducing competition to FICO's near monopoly in credit scoring for a significant portion of the mortgage market. Additionally, FICO reported mixed earnings towards the end of July 2025, which disappointed some investors and contributed to the stock price drop. Beyond this major event, Fair Isaac Corp's stock has faced other downward pressures within the past year. Valuation concerns have been a significant issue since May 2025, with analysts questioning if the stock's premium valuation leaves little room for operational missteps or economic slowdowns in credit activity. The company's recent guidance also contributed to the decline. In January 2026, FICO provided full-year revenue guidance for fiscal 2026 that fell below analyst expectations, despite reporting better-than-expected first-quarter fiscal 2026 results. The company reiterated its fiscal 2026 guidance, projecting revenue of $2.35 billion against analyst expectations of $2.441 billion, and adjusted EPS of $38.17 compared to the consensus of $40.70. These factors have collectively contributed to Fair Isaac Corp's stock price drop of over -17.98% in the past year. Fair Isaac Corporation market capitalization of $36 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Fair Isaac Corporation holds a significant advantage in their industry. Fair Isaac Corporation trades at a higher price-to-earnings ratio of 57 times and a lower price-to-book ratio of -20.77 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 193% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the key performance indicators presented in the extracted summaries. Revenue growth is primarily driven by the Scores segment, which experienced a significant increase of 29.4% from Q4 2024 to Q4 2025. Additionally, SaaS software revenue saw an increase of 12.6%, contributing to overall revenue growth. The company's strategic decision to issue $1.5 billion in senior notes and utilize the revolving line of credit for working capital and general corporate purposes also contributed to revenue growth. On the other hand, revenue decline is largely attributed to the on-premises software segment, which saw a decrease of 12.4%. The software segment as a whole experienced a decline of 11.3% from Q4 2024 to Q4 2025. This decline was partially offset by the growth in SaaS software revenue, but still resulted in a net decrease of $3.1 million in segment revenue. Overall, these key performance indicators highlight the importance of the Scores segment and SaaS software revenue in driving revenue growth, while also emphasizing the need for strategic management to mitigate declines in on-premises software revenue. Net income experienced a significant increase from $152,528 in 2024 to $158,373 in 2025, representing a 3.85% growth of $5,845. This upward trend continued into the fourth quarter of 2025, where net income reached $191,931, marking a substantial 27.9% increase over the same period in 2024. The profit margins also underwent notable changes during this period. Operating margins saw an improvement from 40.6% in 2024 to 45.7% in 2025, before slightly decreasing to 45.6% in Q4 2025. Conversely, net profit margin declined from 34.5% in 2024 to 31% in 2025. The reasons behind these changes can be attributed to several factors. The increase in segment revenues by $72 million contributed significantly to the growth in net income and operating income. Additionally, a decrease in operating expenses at the segment level helped boost profitability. Furthermore, higher business-to-business scores, revenue driven by increased unit pricing, and greater mortgage origination volumes also played a crucial role in the improvement of profit margins. The company's debt level has undergone significant changes over the past year. According to the extracted summaries, the total debt increased by $141,138 from September 30, 2025 to December 31, 2025. Additionally, senior notes issuance in 2025 was $1.5 billion, and the senior notes balance increased by $1.3 billion from $1.5 billion in 2024 to $2.8 billion in 2025. In terms of interest expenses, there is conflicting information across different pages. However, the most consistent and clear indication is that interest expenses have increased significantly from 2024 to 2025. The data shows a 44.6% increase in interest expenses from 2024 to 2025, with the amount increasing by $12,518. This significant increase suggests that the company's debt level has led to higher interest expenses, which may be a concern for investors and stakeholders. Management's outlook on the company's strategy is one of growth and expansion. With a presence in over 80 countries, serving thousands of businesses, the company aims to enable timely decision-making through data analytics. This approach is expected to drive growth, with the Scores segment projected to increase by 29% from the previous quarter. Additionally, total revenues are anticipated to rise by 16% year-over-year. Management's focus on growth and financial literacy is evident in their strategy of offering online services to businesses. Furthermore, they are exploring opportunities for strategic partnerships, investments, or acquisitions to further enhance the company's capabilities. This proactive approach suggests a commitment to innovation and expansion, positioning the company for continued success in the market. The company's financial activities have been documented in its reports. One notable aspect is the company's decision to buy back shares. In the last 2 quarters of 2025 and 2024, the company invested a significant amount in repurchasing common stock. Specifically, $162.7 million was spent on share buybacks in Q4 2025, while $159.7 million was allocated for this purpose in Q4 2024. The exact number of shares repurchased is also provided, with 155,124 shares being bought back at a price of $1,723.90 per share. This indicates that the company has actively engaged in share buybacks to potentially boost shareholder value and reduce the outstanding share count. That concludes the financial summary for Fair Isaac Corporation. Feel free to comment below, and I will be happy to answer them when possible.